Hi everyone, my name is Lucia and most of you know me from Twitter as Triangle Investor. In today's edition of CEO and Market Expert Interviews, I'm joined by Trader Ferg, and like his profile from Twitter says, full-time trader with the current investments in uranium, oil and coal. Ferg is active on Twitter, so if you want to see smart thing, no BS, and all that from a speculator view, I urge you to follow his account. That said, Ferg, welcome to my show. It's great to have you.
Thank you for having me on, Lucian. It's a pleasure. And
Thanks.
I'm not that active on Twitter anymore.
Okay.
Now that I have a baby.
Maybe you need to update your Twitter.
Yeah.
Then never mind. So is it just uranium, oil, and coal for you, or there are some other commodities in your portfolio at the moment, Ferg?
Well, there's definitely subsets of those. Like when you say oil, I'm playing that also via like the offshore sector. So, and then also via product tankers. So, but in general, everything ties back to, yeah, they call them the kind of the big three: uranium, coal, and oil. I did have tin, but that thesis is currently on the shelf, and also do sort of a few things around the edges, like some option trades on, like I have an option trade on UBS. Just thought that was silly value when they took over Credit Suisse. But yeah, generally energy, I can't, I think energy is just silly cheap here, and I think it's a great opportunity.
Okay. Can you give us your path to the current status of full-time trader? Explain to the people who are not familiar, what does a trader do, and share us some of your background.
Yeah, certainly. So yeah, it's been a long path, and I never really saw myself ending up here. I sort of joked every 5 years, I kind of worked out I wanted to do something else. I'm off a farm in New Zealand, a sheep and beef farm, sort of grew up in the middle of nowhere there, went to uni thinking I would be a farmer, following my father's footsteps, and then decided that wasn't for me. Ended up going into sort of property development and management, and that took me to Australia, where I got into asset management. Decided I didn't like that industry, and by luck I met my now mentor, which is coming up 10 years of sort of talking weekly. So that was probably one of the luckier events in my life to meet him, and with his kind of mentorship and guidance, and still working my full-time job, I managed to quit my asset management job at age 30 and decided to try my hand at full-time trading. And I'm now 7, nearly coming up 8 years into that journey, and it's had lots of ups and downs, and yeah, times when I thought I was going to have to go back to corporate world, and now yeah, it's yeah, so at some point it kind of all came right, and yeah, had a great few years, and now reside close to the beach in Bali, and have a little family, a dog, and yeah, very happy with how things have turned out.
Excellent, Ferg, excellent. I can say that I have a very similar investing background and philosophy. I'm also a speculator who is loving stuff when they are unloved, and invest in those kind of commodities. Speaking of unloved commodities, what commodities would you qualify as unloved or hated at this moment?
I think it's still a battle between coal and offshore. Probably coal winning out at the moment, just because of the sort of TTF, like all the natural gas coming down, and everyone is essentially thinking the energy crisis is over, thinking that everything's been fixed and there'll be no need for coal moving forward. And you can see this if you look forward in like the futures markets, like there's no real premium being given to a winter, which means like nothing really got learned by the sort of the Europeans in the last winter, with a warm winter, and also China being in lockdown. And so I'd probably give the edge to coal as being the cheapest here,
and the most
also hated. The most hated. Yeah, the most hated. That's key. Like I've just been going through the numbers, where it's something that's completely flown under the radar to most people, is the fact that India held the G20 in New Delhi. And this is only like 2 weeks ago now. This is in, I think it was 9th and 10th of September. And the whole point of the G20 was pretty much to push the Paris Agreement. And within 10 days after them having hosted it and supposedly like nodding their head with all this, the energy minister came out and said, we're going to increase coal consumption by 40% by 2030, which just blows the whole Paris Agreement out of the water. And so like that's 40% on what they were already installing. So they already had in the pipeline 50 gigawatts, and now they've just announced they're going to do another 30. To put that into actual tons consumed, it works out at about 292 million tons. And if you were to compare that with the like world coal consumption, that if you were to separate that out as a country, that'd be the fourth largest entity consuming coal. And so, and this has got no press. Like Bloomberg hasn't run it. Like if you type this into Google, there is almost no coverage. The last Bloomberg and Reuters are talking about how they're going to get net zero by 2050. It's absurd that this didn't get any coverage. And at the same time, China is just plowing ahead with its own build out. Like if you take their permitted, then they're going to install about 2/3 of what India's entire coal consumption is currently, which is just enormous. And if everything that's planned gets to the permitting phase, then they'll install essentially an entire India with the additional that they've just announced, and they'll do that all by 2030. And this just, no one's, I don't find this anywhere in the news. No one wants to talk about this. Everyone just sort of kind of sweeps it under the rug and pretends it's not happening. And it's massive when you consider that's the kind of the demand side that's not getting talked about. And then on the supply side, US is the biggest, has the largest coal reserves in the world. And I think it was just, I was just reading an article that Michael Bloomberg's just committed another 500 million, essentially a legal fund to try and shut down the remaining coal plants, to bring legal action to anyone trying to permit or just essentially stifle any supply response. And then Australia, you've got like the royalty jack up in Queensland, just essentially killing incentives, supply incentives there. You had Glencore walk away from their coal project. You had BHP sort of throw up their hands and say, this is crazy. We'll put our mines up for sale. And so like that picture is just setting up for such a long runway with coal. And that's why I just, I love the sector for the long term. I think it's going to be, I wrote a post on my original blog called Coal's Moat, and I just still stand by that it's the one sector that I just don't know when you'll get a big sort of capex response. Like I think we're a lot of the supply where, as I said, US is the largest, has the largest reserves, and then Australia has the third largest, and Russia's in the middle. Like between US and Australia, they're just going to stifle this kind of any capex response, and that means higher prices for longer.
Ferg, a lot of people are telling the commodities, mentioning commodities super cycle. Do you think that we are seeing this super cycle going on, or we will see it, or we can take it so general? I mean, some of the commodities will perform good, some bad, some flat. What's your take on this?
Yeah, I think it's a good point, because some people sort of, like the blanket statement, all commodities will perform uniform, exactly. I think is, you got to be really careful with that, because I for one have been kind of very skeptical with a lot of the demand projections with a lot of the battery metals. Like I really question, one, will the EV adoption live up to some of these projections? Because I've always questioned how much of the EV adoption, especially in the West, was just like rich people with high subsidies, like kind of like forecasting like Norway's adoption and pretending like the rest of the Western countries will follow that curve. I think it's a bit naive. And so as soon as you question that, then you got to back up to, okay, well, how much of these sort of demand projections are going to materialize? And then you've also got the fact that makes it equally hard is the likes of BYD. All their current battery technologies done away with, like cobalt and nickel. So you've got this kind of this constant, if a price gets too high, then it gets substituted, and that's just too hard for me. I'm quick to put some commodities in the too hard basket. And then you've also got the whole gold argument. And I've kind of been very hesitant to have any precious metals in the portfolio for the past few years, just because
Not
I
even
think it does
physical.
run. Pardon?
Not even physical metals. I mean, physical gold.
I would like physical. Yeah, I'm just not wealthy enough. I think it once I hit certain goals and I want it as insurance, then I think it's prudent to have maybe 10% of my wealth I'd like to store in a vault. But it's I'm not at that point yet. I want to make all my capital work quite hard for me, and for now I'm sort of balls to the wall.
Okay.
And with gold, it's always, it's a political metal. Like that's the thing that right from the start, when I first researched it, I was like, why does supply and demand not just like, why is there not some hedge fund that went straight into the, went and bought a whole lot of futures and demanded delivery? Like, why hasn't that happened? And once you dig below the surface there, you realize it's the paper market just expands to ensure that gold always stays in a range. This has gone on for a long time. No one can tell you how big the paper market is, and
yeah,
yes,
especially in silver.
Option. Yeah. And so as long as that goes on, yes, there's a call option that eventually the paper market will probably get taken out by the likes of China. They're already kind of starting to have more physical settlement, and I think it's in their interest, along with Russia, to eventually kind of wipe the paper market out. But it's a stretch for me to bet on that too heavily, especially when energy is this attractive. And I think energy will largely front run precious metals as well. I think a lot of the sort of cost inflation and just general inflation that'll come from energy prices running will feed into people being scared, especially if the Fed's printing into like high inflation, then that will cause a sort of a rush for the sort of the safety of precious metals to hide from kind of currencies being devalued.
Yeah. Ferg, let's discuss uranium, the most hated commodity a few years ago and now getting more loved. When did you enter
more love
uranium?
Lately.
Yeah. When did you enter uranium and what attracted you to it?
I think some of my first uranium investments were right back in sort of 2017, 18. I first dipped my toe in the water. And that was a painful trade. Yeah. And when it was kind of like, get some gains and then you'd sort of give them all back. And I was quite fortunate in the way I ran my portfolio. I had two separate portfolios. I had one that was like long-term gains, and I had one that I essentially income traded and lived off. And just by pure luck, in the end of 2019, the volatility got too low that I couldn't make income off my income portfolio. So that was all sitting in cash. And I was kind of having my trading crisis, like, how am I going to make money moving forward? What's going to be the opportunity? And at the time had been doing more and more research on uranium. And that was just when March 2020 came around, and I saw prices that I never thought I'd see. And those were on some companies that I'd spent quite a bit of time researching. And so that whole income portfolio essentially went into mostly uranium, a little bit of nat gas and a few others, but mostly uranium at that point. And that's kind of the foundation for what my portfolio's become today.
I want to ask you about specific names, but can you tell me, what did you buy at that moment? Was it the explorers, producers, developers, or maybe ETFs?
I'm happy to say the one I've talked about a few times. I bought Paladin. So it was the one I'd done the most work on. I always tried to keep it simple. Like I don't think I'm particularly smart when it comes to mining. I know I'll probably get ripped off like every other retail investor. So my whole take was just to find a shuttered mine that was economic, and I thought would definitely restart in the future. And so, the two biggest positions at the time were Paladin and Boss. And just it happened to be that Paladin was the one I'd done the most research on, and I already had my sort of starter position. And I think it was around 12 cents. I built the position then. And then March 2020 came around, and started the slow grind down of like, 10 cents, 8 cents, 7 cents, 5 cents. And then I started putting orders in the market and I was like, this is just ludicrous. And I think, got right down to even got filled on one that was in the 3 cent range, which is just absurd. And so keep hitting the bids there. And that was the biggest position kind of built at that time.
Yeah, you know the Rick Rule story when he bought Paladin at 10 cents and it went to 1 cent and after that went to $10. So maybe this is a similar scenario for you.
I don't think so, but I'd love it, but no.
You never know. Ferg, can you tell me what are the most important metrics to keep an eye on when doing a due diligence in one uranium company's? What's your green flags and red flags?
Well, I say I wish more people with miners would just pull up share count, the history of share count. I reckon that would, if nothing else, a lot of these companies are just diluting, and that's their whole business plan. They don't really ever intend to get anywhere. They're just going to dilute you. And so something like Koifin Free, which I've always recommended, it's just this great platform. I've used the free version for years. They didn't really have that great upsell. Like the free version is fantastic. And you can just click on shares outstanding. You can bring up the history of it, even 10, 20 years. And you can just see like what is the company. Like, probably if I just needed one piece of information with some companies at the moment, that would probably be the first chart I'd pull up. Like coal companies, you can see buybacks. You can see them buying back their stock. Like that tells you an awful lot about what the company's going through. You can bring up some of the historic shares outstanding of like tobacco stocks, and you just see what happens when they buy back sort of single-digit amounts of their float every year. The performance is crazy, and obviously the other side of that, you see what sort of performance you get when you got a shitco that prints shares constantly and pays himself a nice salary. And I've pointed out some of them have some pretty dodgy tactics. So I think people would do well to just pay more attention to that and understand that mining's hard. Mining's super hard. Just be very careful going into any miners. Like I've also, with some of the cost inflation, is just horrendous across the sector. I really did trim the vast majority of my kind of explorate or sort of development exposure just when I started to see some of the cost inflation coming out of the likes of Kazatomprom and Paladin. They're both running sort of 30-40% cost inflation. I was like, well, what's X company with its it's lasted what is DCF? Not DCF. Forgetting the letters are escaping me, but when they last ran their sort of their numbers, and sort of it could have been like 5 years ago and hasn't been updated since. And what will those numbers be with this if the sort of bigger companies are experiencing that cost inflation? What will those numbers look like now? And so really dialed them down and focused more on the guys with kind of ideally with mines already in place. But that's one of the angles I've tried to focus on in my portfolio is if you can get stuff that's been written down to zero in a bankruptcy and you get it on the balance sheet for free, like it's fantastic. Whether it's, I've used Peabody as an example when they picked up their mine. I think they paid $5 billion for their met coal. Again, the name's escaping me. MacArthur, might be wrong. And then they went through their bankruptcy, wrote off roughly $5 billion, and then popped out the other side with more manageable debt and the assets. Same goes for a lot of the offshore sort of drillers, and that they've acquired all their fleet for a massive amount of cash and then wrote all that cash off, wrote all the debt off, and still have all the assets. And that was also what attracted me to Paladin. It had gone through a bankruptcy, written off sort of 300 million. It's when you get into these companies, you're often getting in with what were previously the senior debt holders that have taken a sort of debt for equity swap. And so they want the company to have sufficient runway so they can sort of make their money back. So it's one of those times that you're not actually getting screwed, kind of like you often do when you go into some of the more shitco's.
Yeah, good point. Ferg, do you rely more on technical analysis or fundamental?
Probably 95% fundamentals and probably 5% technicals. I do enjoy technicals for helping me sort of narrow in on what I like. Like I still think there's quite a bit of information in sort of a company that's bucking the trend. Like if you're kind of looking at a whole lot of charts that are going from sort of top left to bottom right, and there's one that's holding its ground or breaking out, I often dig into that. So I do use technicals in that way to help sort of just ask like what's going on, or if something's been bottom crawling for a long time and it's showing signs of life, then that will give me a reason to research it. But I would never make a trade just purely on technicals. I have to sort of develop conviction and want to hold the sector, because it's my whole kind of the whole angle how I come at the markets. I like to get into really hated stuff. It's a reflection of my mentor as well. He likes stuff that's sort of just come out of bankruptcy or just hated, calls them sort of dogs, like bottom crawling along and then start to show signs of life. Generally really cyclical stuff.
Cyclical, yeah, I understand.
Mm.
Ferg, do you see uranium stocks at the present with still a good entry point at this level, or would you say that speculators' train has left the station? Well
and truly left the station. Yeah, you've missed it. Yeah.
Yeah.
Unless, some people have asked, is it like YOLO the shitco, like just go right out the risk curve? And sure, you probably make money doing that, but that's not how this game works. You've got to front run FOMO. You don't make money by chasing FOMO. It's the train's left the station, which annoys people when I say that, but it's true. Just look for something that people are ditching. Like it's interesting, even I've talked about even DMs, like the point at which some people flip, like some people sort of said you're wrong to not be in silver, and the point at which they throw in the towel and say, you're right, I'm getting into uranium, I'm ditching silver. I'm like, okay, I'll have a look at silver now. Just always be where someone said, like, this isn't working, this is crap. You're pretty much trading human behavior, the flaws in it. Like if you can just always take the other side of people's innate sort of behavioral shortcomings, never do something that feels good. Like jumping on uranium at the moment, where everything's green and jumping up 10% feels great, but it's not how you make money.
Of course, it depends on your expectations. You would agree, of course. There are investors that are satisfied with 50% gains, and there are some that
like everything.
Yeah, definitely. Then, Ferg, when is the good timing to exit from one trade? And I'm talking specifically uranium. What signs should one investor keep an eye on that could potentially signal him that it is time to move on?
Yeah, so I wrote a blog post on this on my original blog that I used to, I still keep it up. It's traderferg.com. It's called Avoiding the Monkey Trap. And it was my attempt to answer that question. And I split it into two parts. So it was fundamental reasons to exit and then behavioral reasons to exit. And that's the idea that exiting is more of an art than it is a science. Like you can't have exact reasons, because you never know how far markets, investors or speculators will take a market.
Agreed.
And so it was all based around a whole lot of little signals that you would see to start scaling out. So each signal was, I think I gave it 5% scaling. And the first was uranium rising above kind of the incentive price, the top of the cost curve. I think at the time I said it might have been $90 a pound. I'll probably add some cost inflation to that and put it north of 100 now. And then there's a whole lot of other little factors like X number of explorers coming onto the uranium scene, spot exceed term by I can't remember how much. Trying to think what are some of the other fundamentals were. And then it moved on to behavioral, and behavioral that's where it really comes down to just kind of the crowd effect with it, and especially with being such a small market and everyone jumping on. I think some of the classic ones, like if the taxi driver turns around and asks you, are you invested in uranium? When you've mentioned in it passing a few years ago, and you turn up at a barbecue and the first conversation when you walk over to the group, they're all talking about uranium. If your mum asks you if you're still invested in uranium, like each of those should denote a 5% of scaling out. And it's an art. As I always say, you'll miss the top. You'll get out early, but that's the only way you can play this. You're thinking you'll catch a top dooms you to ride down the other side. And it's there's sort of, I think the analogy I used in the write-up was one of those big sort of theaters, and it's just the idea that you can watch the whole show and still make it out first at the end. Like you have to leave the show early. You're probably going to miss some good stuff if you want to get out. Otherwise, you can't stay to the end and expect that you'll beat all the other people out. And it's just the way it is. Leaving stuff on the table is part of the game. And something I want to focus on more when I update it is also be like the relative side of things as well. It's a lot easier to exit something that you've done really well if there's something else quite attractive. And I'm hoping coal is that thing. I'm hoping the supply side we haven't really seen a jump in CapEx. And so it'll be far easier to take that money if you put it into something that you've got a very positive, like long-term outlook on. One of the hardest was what my mentors talked about was in sort of the run up to 2008 was he just couldn't find value anywhere. Everything was getting expensive. And at some point he just had to go to cash and sit in cash and see everything keep going up higher and higher every day. And he said that was really gut wrenching. And because he was a proprietary trader with banks' money. And so his whole bonus and all his obviously incentives were tied to it, but he felt like he couldn't be part of that market. And so that will be the far tougher reality if that comes to be.
But Ferg, do you take some money off the table during your investment? I mean, let's say uranium. Did you take some money off the table and leave the rest when you reach certain amount of gain, or you are cashing out all at one moment?
So I haven't taken any money off the table apart from, as I said, I lightened up on some of my sort of more speculative developing exposure, and that was to try and kind of balance my portfolio. I've always theoretically wanted 1/3 uranium, 1/3 coal, and 1/3 oil. And just by the dynamic of a lot of the uranium running hard, it became at one point, it was like 75–80% of my portfolio. And so I was trying to kind of rebalance that to a certain extent. But yeah, no, never binary decisions, unless the only binary decision where I'd really take everything off the table at once is if saw something I really didn't like from management. They really kind of, I think they're like pivoting, or they're just not being truthful with investors, and that's kind of a red flag, and I'll move on. But yeah, generally there's no binary decisions. It's all slow scaling, and that just helps kind of like the worst thing that could possibly happen to you is like what happened to Stanley Druckenmiller and .com boom, is that he got out early and then he just watched it keep going up and he couldn't help himself and got back in. And kind of scaling helps you avoid that downfall, is the fact that if you, even if you, it's like a funny quirk of human nature, even if you probably still have 10% and you've moved the other, you can still kind of be celebrating the performance of your last 10% when it's not as material as if you're riding it with your whole account. And so if you want to try and catch the top in uranium, sure, do it, but do it with 5–10% of your account and have moved the others all to something with far better relative value. And I'm hoping it's coal. Maybe it's something else. Maybe I'm buying sort of stuff coming out of foreclosure in New Zealand and Australia and the property market, or maybe it's, I don't know, maybe it's something else that I can't even think of now.
Yeah, got it. Let's touch a bit on oil too. What is your take for oil as a commodity, and where is oil now in the investment cycle? Is it a good buy at this level, not a good buy at this level? Wait for some time to invest? What's your take?
I think it's great here. I think it's we've seen some recent news that just isn't really getting any coverage, as well as with Tracy Techical. She just put up on her Twitter feed the fact that Permian's rolling over, and no one's really paying attention to that. That was the last kind of prospect of growth in the oil world between Saudi, and Saudi's obviously extended its cuts and just it's not going to come racing to the rescue. And then now you've got Permian that's done its third consecutive month of declines. That wasn't on most people's sort of forecast. They thought once oil starts to creep back up to 100, you'll see a sort of a supply response out of shale. And now that's not happening, and kind of most people are aware of the decline rates in shale. Then this gap's just going to continue opening up. And I think OPEC's oil forecasts are going to be the closest to being correct. And they're forecasting 105 million barrels a day of consumption sometime next year. And that was most forecasts were that was going to happen in 2030. So this is really like going to hamstring the green transition. That's taking nearly 6 years of runway that they thought they had. And also all that cost inflation is going to feed through as oil goes higher. And it's just going to blow these projects out of the water. We're already seeing what's happening to a lot of the wind projects with before energy's really run. And so I think this will be the death blow for a lot of that stuff. And as that stuff, as the sort of announcements of whether it's Virtas, whether it's Siemens Energy, as these guys all sort of implode, so will those wind projections. And then the question has to be asked, like, well, what's going to take up that slack? We need to start investing in fossil fuels again. And then that's where I think the cycle is going to head, and it'll be interesting how quickly that occurs. I've kind of been wrong on thinking there might be a realization sooner, and some people I really respect think it's just it's going to take a lot more pain until that realization hits in. But yeah, I think oil's fantastic here.
Final question for you, and that is, you mentioned tin. Same question like for oil. Is it a good timing for buy, or we should wait a little bit? Not a good time to buy. What's your take on tin?
So it's on the shelf for me. I don't own any tin miners. I probably would be in tin if it was I had a cleaner way to play it. Like with oil, I love playing it via the future options. You've still got steep backwardation, so everyone just feels with oil they've missed it when it's run up to over like 90 now. And thing is, the backwardation's got steeper. It was sort of 10%, now it's back around 20%. And so that means if you're buying out to sort of late 2025, like the sort of November 2025, you're only paying sort of $73 a barrel, and volatility's at the lowest it's been in sort of a 4 or 5 years. And so you're getting a really clean trade there, and that's I love those sort of setups. But with tin, there's no real futures. There's no Alphaman's great, but then you're having to go into the DRC, and yeah, I've lost enough nights sleep over being in Africa already. And also, yeah, Metals X, it's the same. I'm not really sold on the company. I guess they'll both do fine probably, but for me, I just prefer a lot of the energy names. I've kind of got quite a high hurdle rate at the moment, just because I think there's so much value around that. I don't need to go with stuff that I think will do okay. I think there's some stuff that's really gonna shoot the lights out, so I want to be there.
Okay, that was Trader Ferg. Thank you very much for coming to my show. It was a great chat, and I wish you luck with your investments, especially uranium, since it is my largest investment. Thank you very much for being my guest.
Thank you for having me on, Lucian.